Welcome back to another episode of Trading for Beginners. This time we're going to switch our attention to the most important area of your trading, risk management. You see, it doesn't matter how amazing you are at spotting opportunities or how great your system is, because if you aren't able to manage your risk properly, you'll eventually end up losing a lot of money anyway. And if there's one thing we don't like, it's losing money unnecessarily. So in this lesson, we'll go through one of the basic elements of risk management, which is how you decide what size trade you should open. Just before we get started, as always, please do hit the thumbs up button if you're following the series, and don't forget to subscribe to the channel if you're not already, so you don't miss out on any of the future episodes of this Trading for Beginners series. Okay, so the size of our trades is pretty damn important, because if the trade's too small, you won't be making much of a return on your trading opportunities when they're profitable. And if the trade's too big, you'll run the risk of taking a big hit on your account if that trade loses. And if the size of the loss is too big, it can also lead to your loss aversion kicking in, which then affects your ability to think rationally when managing your trade, and these sorts of things can eventually lead to you burning out your account. So position size is a pretty big deal, but unfortunately a lot of traders just don't seem to get it right. So let's assume that we're opening a long trade on Euro USD. So if it's a long trade, that means that we're going to be making money if the price moves up. Now, how do we know what size trade we should open? A lot of traders, especially beginner traders, will use an approach that we call a static position size. This may have different names elsewhere, but that's what we refer to it as, and really it's the concept that matters here rather than the name of things. A static position size can come from a few different approaches, but the problem is they are all wrong. This is where a trader will open a standard position size based on their account size, regardless of the opportunity that they're trading based on. One of the common approaches to static position sizes is when you use a standard monetary value. For example, if you open one standard lot for every $10,000 in your account, regardless of the opportunity. So in this case, the total amount that a trader is going to have at risk with that trade is going to depend on how far they let the trade run against them. Let me explain. So any position size is going to have a value per pip. For example, if your position size is one standard lot and you're trading Euro USD, it's going to be $10 per pip. If the price moves one pip in your favor, you're making $10 profit. And if it moves one pip against you, you're making $10 loss. Therefore, if you have two different trade opportunities and you open one standard lot for each of those, if one of those opportunities has a 20 pip stop loss, you'd be risking $200 on it. And if the other one has a 10 pip stop loss, you'd be risking $100 on that one. However, what if the one where you're risking $100 is actually the better opportunity and the one with $200 at risk is not so good? You're risking more for the worst trade in that situation. From a logical point of view, you'd be wanting to risk less money on the worst opportunity. But since you're using a static position size and that opportunity needs a 20 pip stop loss, you're actually risking double. It doesn't sound like a very intuitive and sensible approach, does it? The other common way of using a static position size is if you have a standard percentage of your account at risk, regardless of the opportunity. So in this case, for both of these opportunities, you'd be risking 1% of your account for both of them. 1% for this one, 1% for this one. That means that the position size for the trade will be different. The one that requires a 20 pip stop loss will have a lower position size than the one that needs a 10 pip stop loss. But ultimately, since that stop loss is further and the position size is smaller, the loss will still be exactly the same in both situations. It's still 1% static. Now, this approach is slightly better than the first approach we discussed, because at least with this one, it keeps the loss equal and doesn't run the risk of worse opportunities carrying a bigger loss. But the downside of this approach is that all opportunities are being treated equally, rather than bigger positions being taken on the better opportunities and smaller positions being taken on the worse opportunities. Instead, we shouldn't use a static position size at all. We should use a dynamic position size. This means that the position size is going to vary depending on how good the opportunity is and the number of pips that would be needed for the stop loss. So the starting point for deciding your dynamic position size is to decide the percentage you are willing to risk. In other words, if the trade goes against you and triggers your stop loss or whatever other approach you're using to exit your trades, it won't be any more than that specific percentage of your account. Now, this should vary depending on the estimated potential success rate of the opportunity. In other words, how likely it is that that opportunity is going to succeed. Now, this is going to depend on your specific system or method of trading, and if you don't have one yet, then don't worry too much about that for now, because as you start learning more about trading, you'll understand more and more about what makes a good or a bad opportunity according to your specific system. But I would personally recommend that regardless of what the setup is, you don't go any higher than 2% at risk. So that means the very best opportunities in terms of potential estimated success rate will get closer to 2%, and the worst opportunities, although you still have to be sure that they're viable opportunities in the first place, they'll have much less at risk. So that's your starting point. You know how much you're willing to risk as a percentage of your account for that opportunity. Next, you need to know the maximum loss size in terms of pips. Now, if you're going to be using a stop loss, which I recommend, then this will be how many pips from your entry to your stop loss, right? The number of pips from your entry to your stop loss. And this should again be based on the opportunity itself and defined by your specific system or method. But if you have no idea right now where to place a stop loss, again, don't worry, because in fact, in the very next episode of Trading for Beginners, we'll be covering that. I'll be talking you through where to place your stop loss and why you should place it there. But let's say, for example, that you decide on a stop loss of 20 pips. That's right for that opportunity, and you see that is an above average opportunity for you, so you decide that you're willing to risk 1.5% of your account. Now, if we say that you have $10,000 in your account, then that 1.5% is going to mean that you're risking $150. So now we've assessed the opportunity and we know how we're going to be approaching it and how much we're happy to have at risk. But we don't yet know what position size we need to open. So here's what we're going to do. If you take the amount that you'll be risking in monetary terms, so in this case $150, and divide it by the number of pips at risk, so that was the number of pips from your entry to the stop loss or whatever point you're going to exit, then you'll have the total amount per pip. For this trade, that would be $7.50 per pip. Now, if your account is already in dollars, that should make things relatively easy for you. You know that if you open 0.75 of a standard lot of Euro US dollar, because remember we're going long Euro US dollar, then you'll be risking $7.50 per pip, which for your stop loss of 20 pips means that you have a total at risk of $150, which is 1.5% of your account. So let's quickly compare that to a trade that isn't as good and that needs a wider stop loss. So let's say, for example, you decide for this opportunity to only risk 1% this time, and this time you need a 40 pip stop loss. So 1% of your $10,000 account is $100. Then if you divide this by your 40 pip stop loss, you get $2.50 per pip. Therefore, you would open 0.25 of a standard lot of Euro USD. Do you already get why this approach is just so much better than a static position size? I mean, now the amount at risk varies depending on the opportunity itself, and the size of your stop loss isn't affecting the percentage that you have at risk. The amount you're risking, and therefore the amount you can potentially profit from the trade, is dependent on the opportunity itself. If, like me, your account is in a different currency other than US dollar, or you're using different assets other than Euro US dollar, the calculation can have a few extra steps in it. Now, although this is still relatively easy, it's much quicker and much easier, especially when you're in a trading session, to just use a position size calculator instead. There's plenty of position size calculators available for free online. You just have to Google them. So for example, if we look at this calculator here, it's showing the first example that we gave on a US dollar account, the one that we just went through. But if we change the account to GBP, so British pound sterling, you can see that we get a completely different outcome. I think it's a really good idea to go through some practice activities to make sure that you fully understand what you've just learned, and just to make sure that when you come onto it in a trading session and the pressure's on, you already know exactly what you're doing and you feel totally comfortable with it. So on screen now, you can see some different examples, and you should take some time to work through these activities and then leave a comment below with your answers. As I mentioned before, in the next episode of Trading for Beginners, we'll be talking about where you place your stop loss and why. So in the meantime, get comfortable with that position size calculation. It'll be very useful for you next week. And if you're new to trading and loving this series so far, hit the thumbs up button to let us know, and don't forget to subscribe so you don't miss the future episodes. Also, check the description box below for our social media links, especially for our live stream sessions on Tuesdays and Thursdays at 1 PM UK time on Facebook. That's where I dive into the markets and show you how I'm seeing things. And of course, if you want to know more about the specific method I use to trade and have used for over a decade, then check out the free intro course in the description box, Introduction to Trading the Duomo Method. It's 2 or 3 hours, definitely worth your time. But until next time, thanks a lot for watching, and I'll see you then.